Platts Oil Matters podcast in association with the Oil Council.
My name is John Kingston, and welcome to this month's edition of Oil Matters. We're directly from the America's Assembly of the Oil Council in New York here in early October, and with me today is Curtis Burton, who is the CEO of Buccaneer Resources, which is a U.S.-based, Houston-based company. Mr. Burton spoke yesterday at the America's Assembly of the Oil Council, and he's with us today to talk about a fairly different tack that his company has taken over the past couple of years. Thanks for joining us today. You've been a long-time producer in the shallow waters of the Gulf of Mexico. How does a company like yourself end up in the Cook Inlet of Alaska?
Well, first of all, thanks for the time, John, and happy to talk about how we got to all of the different things that we're involved in. I think the main thing that, at least as CEO, I do in a small independent is I'm always looking at what do we do next? What's over the horizon that can really add value for the shareholder and value to the bottom line of the company? And the basic tenets on which we founded Buccaneer were really two-pronged. One was to mitigate risk, and the other was to look for unique opportunities. Risk mitigation involves a whole host of things like taking majority positions, operating your own properties, always going into basins where you're sure you've got regional expertise on your staff. You can't do what you do in the Gulf of Mexico and expect to go into the Balkan with that same group of mentality and be successful. You need guys that know those areas. So when we talk about risk mitigation, that's a big part of what we do. Second leg of what we were founded on is looking for unique opportunities, looking for places you can get things online quickly and special, unique things that make an opportunity. You ask how you go from Gulf of Mexico, shallow, deep, whatever, to Alaska. It's because it fits that profile. We had an opportunity. As part of my job, I was looking at, okay, what do we do next? And one of the guys that we'd been working with came in and said, Alaska. And I said, too cold, too green, too far away, too difficult. Just doesn't really ring the bell for me. And he said, well, I think maybe you ought to look a little closer. And so we spent about a month really looking at Alaska, and what we discovered was that it fit both of our key criteria. We had a way to mitigate risk because we found a group of 8 people who had spent their entire careers working Alaska with the various majors, ARCO and Union and others. And secondly, it had a unique set of qualifiers that made it an opportunity that was being ignored by everybody else in the industry, essentially.
Well, being here at this Oil Council meeting, it really is unique. I was up in Alaska 2 weeks ago, and it is a rather strange place because everybody thinks of them as having lots of oil, but right now they don't have enough oil to really keep the pipeline operating efficiently. That's right. And in the southern part of the state, where most of the population lives, like Anchorage, they are dealing with a real possibility of gas shortages, and this state that has all of this gas underground may have to import gas as LNG. The drilling that you're doing in the Cook Inlet, the drilling that you're going to be doing, which will find a ready market, is seen as a savior for this. How fast are you going to be able to get gas on, and how readily do you think you'll be able to allow this state to avoid this gas crisis that now looms?
Well, we are doing everything we can to pull the production dates up. We went in, again, one of those ideas about Alaska that's a little bit misguided, I think, based on our experience, was that we felt it would take too long to get things online because of the various permitting and, both environmental and regulatory. The state is very conscious of their responsibility to regulate, monitor, and control what goes on. So that gave us a little bit of anxiety going in, but I guess the proof text is that one of the areas that we have just drilled wasn't in our original purchase up there of leases. And so in a 9-month period, we went from having no leases in this particular area we've drilled in to acquiring the leases, permitting, both environmentally, geologically, and regulatory-wise, everything we had to do in actually drilling and completing our first well. That well is slated to be placed on production sometime in December at this point of this year. So if you look from a start to finish, 9 months or so to acquire, do everything you had to do and drill a well and complete it, that parallels fairly well with anything you can do in the lower 48, having done that a few times. So we were encouraged by that, and the fact that the results turned out the way they did with that particular well opens up, we think, an entire basin for us. We already have 2 drilling pads set up, and we can, funding provided, we can be drilling a well as frequently as once every 4 to 8 weeks, depending on depth and other vagaries.
You mentioned the lower 48, and what's a contrast, again, Alaska versus the rest of the country, is that the price of gas in the lower 48 is extremely low, and the price of natural gas in Alaska is extremely high. What kind of netbacks do you think you might get? I mean, if you could bring that on today, what kind of netback would you get in Alaska?
We just signed a gas contract for all of the production out of that first well. Average value is about $625 a thousand, which is about 65% higher than you could hope to get in the lower 48. That's the average value. It has a bottom limit of about $6 and a cap of $10 a thousand. And in the winter in Alaska, because of those shortages you're talking about, they've seen numbers as high as $15 a thousand in the last couple of years, averaging more like $9 a thousand. So one of the opportunity types of things that we saw in Alaska was that while we weren't necessarily going to Alaska to drill for gas, we saw that because of the special situation with the gas shortage, we could not only drill for oil, but we could very commercially, very attractively drill for gas as well. When you contrast, at least in my view, Alaska to particularly Alaskan state waters, we're not talking about ANWR, we're not talking about federally regulated areas, but the state of Alaska is very aggressively trying to promote drilling to address the gas shortage as well as get more oil in flow lines up there. That, to me, contrasts fairly starkly with the federal government's almost punitive approach that they have taken that I think is, my background is subsea and deep water years before I got involved with shallow water. And I think what has come out of Macondo is out of place to not only the event, but all of the regulatory changes and things that have gone on have just simply served to penalize what's going on in the industry at a time we really need those reserves. And there was fundamentally no issue with what was going on in the regulated environment of federal waters in the first place.
Well, let's go back to Alaska. We talked about the price and the netback, and there's a tax regime up there called ACES, which I believe was initiated under when Sarah Palin was governor.
Right.
It's very controversial. The Congress that I co-chaired at, the final debate was about whether ACES was good or bad. But for you, drilling in the Cook Inlet, it is clearly good. You spoke about that at the Assembly yesterday. Can you talk about the kind of breaks that you get under ACES for looking for gas in the Cook Inlet?
Sure. ACES actually, I think, is somewhat less controversial than it might appear at first blush from the kind of event you're at, because the controversy that I've been exposed to is simply tied to the money for ACES is raised off higher taxes on the North Slope. And so some of the North Slope producers want to see that diminished a bit, and that's a big discussion. But all of the people in government and even in the Senate and the House up there that I know of feel that ACES is doing its job. It's encouraging people like Buccaneer to come up and drill where there hasn't been any drilling going on for some time. The last major discovery in the lower or the southern sector of Alaska was over 10 years ago, so we drilled. The last time that any drilling was done in the Cook Inlet, which is the focus for our oil activity, was over 17 years ago. And that has been a big contributor to why they're gas and oil short right now. Because what happened was when the North Slope was successfully drilled, it's probably no secret to anybody that the oil and gas industry is a bit of a lemming industry. You know, when somebody finds something over there, everybody goes over there. And that's what happened. All of the majors were cloistered down in the southern part of Alaska drilling and having great success. I mean, within a 5-mile radius of where we will drill our first offshore well, they've produced 1.1 billion barrels of oil and 500 Bs of gas. So billions of barrels, 500 Bs, you can hardly say they weren't having success drilling in the southern region. But what happened was as soon as they found even bigger deposits in the North Slope, they basically walked away from all the activity in the southern region where all the population is quartered, and there hasn't been any serious activity down there in a number of years. The opportunity that creates for someone like Buccaneer, who's coming in as a result of the incentives and as a result of favorable tax treatment, is that the analogy that I paint for people that are not in the business is if I came in today and said, let me show you my 1994 vintage Microsoft laptop computer and impress you with how fast and how efficient it is, you'd laugh, because you know how much things have changed since 94. The last time a drill bit was in the Cook Inlet was 1994. And there's been a similar revolution of the industry's ability to image, to drill, to new fluids, new capabilities for horizontals. Subsea was not really all that well accepted in some sectors in 94. So you have a whole suite of technologies and abilities to apply to a basin that is by all stats I've ever seen, grossly under-drilled. If you look at if you're familiar with one of the tools that explorationists use, it's a log normal distribution of, it looks like a big bell, and on either side of the bell you have small discoveries that are going to be seen in a basin, and then you have very large discoveries. Well, that bell curve in Alaska, and in particular in the Cook Inlet, you've had a few of the smaller discoveries that have added up, along with a couple of big discoveries, to that 1.1 billion barrels I talked about. But the sweet spot of that bell curve is undiscovered. So what that tells you is someone like ourselves, where you're going into an area has had, to our good fortune, a fair amount of drilling, so you know what the structures look like and you know where to look. And now you have new tools, and you know that a lot of the prizes that are there are still to be claimed. It's a great place.
Earlier, given how prospective it looks, earlier you used the term funding provided. I would imagine with a guaranteed gas price of $6 at minimum and probably higher, that has not been an issue for you. How have you found the funding landscape?
For all small independents like Buccaneer, money is always what you need more of. If you've got the right talent, and I think we've proven we do, you can always drill up reserves if you've got money. Certainly the fiscal regime in Alaska helps. The fact that we're about to get wells online in Alaska helps. But the trick is always you're looking for money. So it's been helpful, but it's an ongoing process.
Conventional wisdom is that the banks are pretty much out of the lending business, and private equity is the great source of capital for these sorts of efforts. Would you agree?
It's, the recurrent thing that I bump into out talking to people, whether they be banks or private equity, is certainly in the U.S., all of the players are sitting on the sidelines right now. You can show them very strong deals with very strong returns, and because of the instability that they see in the markets right now, they more often than not, what you get is it looks compelling, but we're just sitting pat right now. And that is something that really I have seen firsthand since 2008. I mean, again, one of the reasons you mentioned that we're based in Houston, we're also a publicly listed company in Australia, and I have a lot of people ask me why that's the case. The reason that we are listed in Australia is twofold. When we listed in 2007, you were already getting a heavy reaction to Sarbanes-Oxley and how impossible it is for somebody who is out trying to raise $20 to $50 million to be able to effectively comply with that legislation. I mean, what that legislation has done is it has killed small IPOs in the U.S. They go to the AIM, they go to the Canadian exchange, they go to Australia, Singapore, but they don't come to this exchange. And so you've had a number of things that have sidelined the banks, and then when you got into 2008, again, everybody's reaction in both banking and private sectors was a universal, we need to wait and we need to see how things turn out. With what's going on in Greece right now, you're getting that repeated all over again.
Curtis Burton, CEO of Buccaneer Resources, thank you for joining us today at Oil Matters, live at the Americas Assembly in New York. Please join us again. Thank you.